Hi everyone, I've just finished filming 2 quick videos comparing commercial investment lending versus commercial owner-occupied lending, and I kind of finished the videos and thought to myself, I probably need to zoom out a little bit and maybe you'd benefit a little bit from just understanding some of the broader notions and concepts that come with commercial lending, because it is very different to residential home loan lending. This is certainly not all of the answers. This is just some things I want to point out. Probably more than anything, the reason I'm doing this is to demonstrate that when it comes to my job as a mortgage broker and finance broker in securing the best finance for a commercial property purchase, there are a lot of different things that are important and a lot of different things to consider. Not just interest rate, not just maximum loan amount, but things such as debt structures as well and security structures. So, commercial lending. What do we need to know? Well, we always talk about the 3 C's firstly when it comes to any sort of lending, right? So the first one is character. So it's really important that whether you're a guarantor or not, if you're involved in the transaction and you're a borrower or a director of a business that is borrowing, you need to have really good character. So what does that mean? We run CCR, so comprehensive credit reporting. We want to look for good conduct. We want to make sure that you haven't missed repayments or been bankrupt or had any defaults. Outside of that, just making sure that your reputation is good and there's no naughty headlines about you in the news is pretty important as well. There are a few other things that come to character, but they're the main 2. Collateral. All right, collateral is what are we actually buying? Now, this is so important because in home loans, it doesn't really matter. Of course, we don't want to make sure the property has asbestos or is in a floodplain or is falling over, but ultimately a house is a house. In commercial, especially investment, the type of property you're buying is really, really important. So how long is the lease? How many tenants are there? Is there just one or are there multiple? And also, where is the property? Is it an office space? Is it retail? Is it rural? Is it hospitality? Okay, so what is the type of office space and how liquid is it as well? Is it something that's really sought after at the moment? It might be specialized, so it could be a medical center, it could be a childcare center, something like that. It could be a boarding house. After that, we look at cash flow. I talked about this on the previous 2 videos, but are we looking at an interest coverage ratio assessment? In other words, does the rent cover the interest? Or is it a full doc assessment? Do we need to look at the business and at the sponsors and see whether they can actually afford all the debt as well? Other really important things, loan terms. Are you getting a 1 to 5 year loan term? Or are you getting a 30-year loan term? And that may depend on whether it is a lease doc investment assessment or whether it's owner occupied. I've just realized how poor my handwriting is here. I do apologize. Finally, repayments. Repayments are really important. Do you want interest only? Is the bank going to give you that? Do you want principal and interest? Is the bank going to give you that? So, a bit of a crash course here, but my point is, when it comes to commercial lending, we're not just getting a 30-year home loan at a low 6% rate, setting and forgetting at an 80% LVR. LVR is really important, but what else is important to you? At the moment, I've got a file on my desk where the applicant is buying a commercial property for his business, but one of the directors of the business, so he's one of 2 directors, the other director doesn't have anything to do with the property and lives in a different city. Now, most banks would want a guarantee and indemnity from both directors, but that's pretty impractical in this case because one of the directors doesn't really want to put their house on the line effectively for a commercial asset that they don't really derive a benefit from. So there's one bank out there that won't take individual director guarantees. It's called non-recourse borrowing arrangement, right? It will do that. So if you're paying an extra 0.5% interest rate, but you get that security benefit, that's going to be a much better loan for you. So interest rate's not everything. LVR isn't everything in this space, but understanding structures and terms is really, really important. And again, that's my job to make sure that I'm understanding what's important for the particular client and the particular transaction and marrying that up with the most suitable bank and lending option out there. Hope that makes sense.